Look at this blueprint. Over the next few minutes, we're going to turn this abstract plan into a solid, automated financial foundation for your 20s. The traditional education system teaches you a lot, but it skips entirely over the actual mechanics of managing your wealth in the adult world. To fix that today, you only need 3 things: a steady income, last month's bank statements, and 1 hour of focus time. By establishing this automated baseline, you lift the weight of daily financial stress off your shoulders. That freedom is exactly what allows you to take bold career risks, like joining a pre-revenue startup, and compound your wealth later on. Step 1 begins with your liabilities. Before you make any investments, you need to target and pay down your high-interest student loans and credit card debt. This split-screen comparison shows exactly why. On the left is the stock market. It can yield high returns, but it's volatile and you can lose money. On the right, paying off a student loan with a 4 to 6% interest rate provides a guaranteed mathematical return on your cash. Beyond the math, holding on to debt takes a heavy professional toll. It ties you down to a constant monthly payment, which means you might be forced into a job you don't enjoy rather than taking a chance on an entrepreneurial venture. Once you have a plan to eliminate bad debt, step 2 is building good credit. You execute this by setting all of your credit card accounts to automatically pay your balance in full every single month. Credit bureaus use an unforgiving grading scale. If you make 99% of your payments on time, that is still treated as a failure and your score will suffer. You cannot afford to miss a single payment. Here is an animated breakdown of a $400,000 mortgage over 30 years. With a good credit score, you might qualify for a 5% interest rate, costing you about $373,000 in interest. But with a worse score, that rate jumps to 5.5%, bringing total interest to $417,000. Look closely at the highlighted difference. That is a penalty of $44,000 over the life of the loan, just because of a few missed payments. Debt and credit serve as the financial leverage that will either purchase your future freedom or tax it heavily. Now that your credit is handled, step 3 is the physical audit. Take your recent bank and credit card statements, go through every single line item and force them into 2 specific categories: needs and wants. A need is a non-negotiable expense for your survival and daily operations. This means rent, utilities, car insurance, and health insurance. A want is entirely discretionary lifestyle spending. This includes your streaming subscriptions, dining out, and impulse purchases. This diagram illustrates the 50-30-20 framework using a baseline monthly income of $5,000. Your money divides out into 3 distinct vertical buckets: $2,500, $1,500, and $1,000. You strictly cap your operational needs at that 50% mark, or $2,500. Then you cap your discretionary wants at 30%, which is your $1,500 bucket. That leaves the final 20% bucket. This $1,000 is your untouchable capital, reserved exclusively for savings and future compounding. By sticking to the 50-30-20 rule, you remove emotional decision-making from your spending. It enforces the delayed gratification required to build real capital. Once your budget is stabilized, you cannot leave that final 20% sitting in a standard bank account. It must be deployed into specialized, tax-advantaged retirement vehicles. The first tool is the traditional 401k, an employer-sponsored account. If your company offers a contribution match, you must take it. Failing to capture that match is literally rejecting free money. The second tool is the Roth IRA. This is an individual wealth vehicle that anyone with earned income can open at a major brokerage. This flowchart compares the distinct tax mechanics of both accounts. On the top path, the traditional 401k takes in pre-tax dollars, untouched, but you pay taxes on it at the exit. On the bottom path, the Roth IRA takes in money that has already been taxed at the entrance, so it exits completely untouched. This structure provides a huge long-term advantage. After decades of compounding, every dollar of earnings and profits can be withdrawn completely tax-free. Because this tax loophole is so powerful, the government caps how much you can contribute to a Roth IRA to a few $1,000s annually. But beware of the most common trap. Simply opening and funding these accounts does nothing. They're just empty shells until you purchase an actual investment inside them. This mock-up shows the final mechanical step. You transfer your cash into the account, search for a specific index fund, like ticker symbol VOO, and explicitly hit the buy button. An index fund is a pooled investment that buys into many different assets at once. By purchasing an S&P 500 index fund, you instantly diversify your risk by owning a small percentage of hundreds of the top companies in the US. Once you own those funds, you have to avoid a major psychological trap. When the stock market inevitably fluctuates and drops, the natural instinct is to panic and sell your shares. Historical data from Bank of America shows why that is a mistake. Since the 1930s, if you tried to time the market and missed just the 10 best trading days in a decade, your overall returns would be destroyed compared to simply holding your position. Looking at this timeline chart, you can see how risk diminishes. The probability of losing money in the stock market drops exponentially the longer you hold your assets, eventually hitting just a 6% chance of loss if you stay invested for at least 10 years. True wealth generation is a test of psychological endurance, not timing. Time in the market will always defeat attempting to time the market. Your financial machinery is now active. Your debt is targeted, your credit cards are on autopay, your spending is constrained to the 50-30-20 rule, and your capital is compounding inside an index fund. Now you just have to apply the ultimate wealth multiplier rule. As your career advances and your income increases over the next decade, your lifestyle expenses must remain frozen at their current baseline. By aggressively avoiding lifestyle creep, you generate significant surplus cash. That widening gap between your frozen expenses and your growing income is what allows you to fund major life goals, like a down payment on a house or a dream wedding. To keep sharpening your financial edge, check out the description below to sign up for my free Hump Days newsletter, where we cover tech and business insights twice a week. While you're down there, you can utilize the provided links to claim some free brokerage stocks. And please share this blueprint with a friend who needs help getting their foundation started. By mastering this automated foundation now, you establish the mechanics necessary to move toward financial freedom on a clear, repeatable path.